Hi, today we're going to talk about temporary accounts, posting closing entries, and creating a post-closing trial balance. So you can see here that I have a listing of accounts and amounts. The ones in gray are permanent accounts. They do not get a zero balance. They are not closed out in the closing process at the end of the period. These other accounts that we have down here are temporary accounts. Temporary accounts are closed and brought to a zero balance so that we can start taking and figuring out what income is for the new period, or what revenue or what expenses are for the new period, or what the owner has withdrawn in the new period. So they need to start back at zero so that we can keep track. These accounts will be closed and brought to zeros. So what I'm going to do is I'm going to talk to you about how that will happen. I have some T accounts here. We'll do some journal entries, and then I'll also flip to another page where we can look at what happens with the ledger account. So we can see the T accounts are kind of shorthand for the ledger, but we'll look exactly at the ledger accounts. So you can see that I have capital's amount already in the T account. It has a normal credit balance, so I pop that in. I'm going to go ahead and put in fees income, $3,000. Supplies expense, $200. It has a normal debit balance. I'm going to put it in the debit side. Depreciation expense, also an expense with a normal debit balance. And miscellaneous expense. And drawing is a contra equity account. It also has a normal debit balance. So now that I have all my T's in, I'm going to think about what I need to do to bring these accounts to zero, and then I'm going to make some journal entries. So if I want to bring this fees income account to a zero balance, I have to figure out what I need to do to make it a zero. Well, my credits on fees income are positives. So my debits are going to be negative. So I want to put a credit or a negative on the debit side to bring the account to zero, because a positive and a negative of the same amount are going to bring me down to zero. And then I'm going to do the same thing for supplies expense. Here, the $200 is positive, has a normal debit balance. So the credit side is going to be my negative side. I'm going to credit supplies expense for $200 and bring that account to zero. Same thing with depreciation expense. We have a normal debit balance. I'm going to credit the account, and that'll make a zero balance for depreciation expense. And I'm going to credit miscellaneous expense and have a zero balance in miscellaneous expense. And we do the same thing for drawing. Drawing has a normal debit balance. If I want the balance in this account to be zero, I need to credit drawing for $500. So I'm going to come over here, I'm going to create some journal entries, and we'll see how that works. So right here, I had fees income being credited, fees income being debited for $3,000. So I'm going to come right down here and create a journal entry, and I'm going to show fees income being debited for $3,000. Now, for every debit, I need a credit, or for every credit, I need a debit. They always need to be equal. So I'm going to use this temporary account income summary. Income summary has no normal balance. It is a completely temporary account that we only use during the closing process, and we use it to offset our debits and credits. So I am crediting fees income, or income summary here. I'm going to go ahead and show a credit up here in the T account for income summary. Now I have all these expenses that I was crediting, bringing it to a normal or zero balance. So what I'm going to do in my journal entries is I'm going to credit these accounts again so that they become zero amounts in the ledger. So I'm going to leave a space for income summary because that's going to be my offset account. But I don't really know how much I'm going to need to offset it for. So I'm just going to leave that blank and come on down to the next one. Start with supplies expense. And we know that we need to put a credit in there for $200 to bring that account to zero. That's what we're doing. And then we're going to do the same thing for depreciation expense. We credited in the T to bring it to zero. We're going to credit in the journal entry to bring to zero. And miscellaneous expense, as a normal debit balance, so that credit will bring it right down to zero. And if I add this up, 200, 250, that's $450. I'm going to put that here in my income summary account. And I'm going to come right on up into income summary, and I'm going to put that $450 as a debit. So whatever I've done here, I'm doing again up here. My third step for closing entries is to close income summary to capital. So I'll find my new balance in income summary. I'll put a little line here, and I'm going to say it has to be a credit because my credit's larger. So 3,000 minus 450 will give me a credit balance and income summary. But income summary is also a temporary account. It's very temporary. We only use it during the closing process. So I want to bring this account to zero. I'm going to debit it. And that will allow this account to be brought to a final zero balance, which is what we want. I'll just set the zero over here, but there's not a normal balance, so it doesn't really matter. I'm going to come down and create my T. Since I am have a debit here for income summary, I want to make sure that down here in my journal entry that I'm doing the same thing. So I'm going to come right down here and debit income summary. So income summary debit, and that's for $2,550. And my offset is going to be the capital, because remember that this is the expanded fundamental accounting equation that includes revenue and expenses, and then all eventually rolls back up to capital. So I'm going to credit capital for $2,550. My final step in the closing process is to close drawing. So you can see here we needed to credit drawing and we need to debit an account. We're going to debit capital because that is the offset. It needs to be reduced by the amount that the owner withdrew from its account. So I'm going to credit drawing to bring it to zero and debit capital. And then I'm going to come on up here to capital, this T account, and record. I'm going to show this $2,550 credit, which really represents net income, right? Revenue minus expenses. And then I'm going to debit for $500 the amount that we took out from our owners, our drawing. And I'm going to find my new balance of capital. So I'm going to say my old balance plus my net income minus my capital. So this really reflects the statement of owner's equity. Is going to be $6,150. So what we want to do real quickly is I want to share with you how we're going to do the ledger accounts. So we'll come over here to sheet 2, and I have some ledger accounts and I have capital set up. The first thing we need to do is put in the balance. So we'll go back to our sheet and we'll see that the original balance of capital was $4,100. So I'll put that in the credit balance. And then we have our closing journal entries, so they would take place on the last day of the month. I'll put it in here as the 31st. And if we look back, the first thing we did to capital was we credited it for $2,550. So we would come to our ledger, we would put in a credit for $2,550, and a credit, and a credit's going to be positive. So I will say 4,100 plus the 2,550 is going to give me a new balance. So I have that journal entry recorded. I'm going to come on down and next take a look at fees income. So fees income originally had a balance of $3,000. I'm going to go ahead and set up that T. I'm going to say balance and $3,000. And if we look back at sheet 1, what we did to fees income is what we did to fees income was a debit for $3,000. So if I go to sheet 2 and I come to fees income, I'm going to create a debit. That was my journal entry. And a $3,000 debit and a $3,000 credit is going to give me a 0 in there. And we'll show a 0 balance. That's what we want to see in these ledger accounts. Going back to sheet 1, we have 3 expenses: supplies expense, depreciation expense, and miscellaneous expense. And their balances were $200, $250. So let's go set up the ledgers. See, miscellaneous expenses first. It had a debit balance of $50. Just type balance in there. Depreciation expenses next. It had a balance of $200. And supplies expenses last. It had a balance, a normal debit balance for expenses of $200. When we come back to sheet 1, we can see that we credited these 3 accounts for the offset. For 200, 250, we created credits. So I'm going to come back to the ledger. I'm going to find my 3 expenses. I'm going to credit miscellaneous expense for 50 and show a balance of 0. And that's what we want. We want these accounts to be closed. I'm going to show a credit of $200 in depreciation expense and a 0 balance. And that's what I'm looking for. That is what I am looking for. And finally, supplies expense, I'm going to credit for $200 and show a balance of 0. Looking good so far. So I have everything done but drawing. Drawing had a balance. Let's check and see what the drawing for balance was. It was $500, so I'm going to go to sheet 2. So drawing had a normal debit balance of $2,000. If we go back to sheet 1, we can see that we had a journal entry for drawing of $500 credit to bring the account to 0. So we will do that. And we can come up here then and do the last journal entry for capital, and we can see that we credited drawing, but debited capital. So we'll record that final amount in drawing as a debit, $500 to reduce capital, and it will. We'll say this $6,650 minus 500 is going to give me a final balance of $6,150, and that's going to be my balance in capital after the closing entries are journalized and posted to the ledger. The final step is a post-closing trial balance. So what I'm going to do here is I'm just going to hide our old T accounts. We're just going to hide them out of the way. And you can see that now I have a template being set up for a post-closing trial balance. The only accounts that should show up in a post-closing trial balance are these accounts, the ones that I have grayed out over here. These are the permanent accounts, and nothing changed to these balances for most of them when we did the closing process. So I'm going to copy them. I'm going to copy them all over. So I'm going to put the amounts right here, and the I'm going to copy them over and paste them. And then you can see that we have all the amounts in the debit and credit column, which is not going to work very well for us. So we're going to have to kind of figure that out. And I'm going to delete the capital amount because that account actually is changed during the closing process. So cash, supplies, accounts receivable, and equipment all have normal debit balances. This accumulated depreciation is a normal credit balance. So we'll move that over, and I'll delete that one. And accounts payable has a normal credit balance, so I'll move that over and delete it. So now you might say to yourself, well, how do I know what my new capital number would be? Well, you could look at the T account or you could look at the ledger. Let's look at the ledger. We go to sheet 2 and look at the ledger. Here you can see that our final balance was $6,150. So I'm going to go back to sheet 1. I'm going to put in $6,150. Now I need to be certain that my debits equal my credit, so let's add them up. And I have $13,150 and $13,150. So that becomes my total. My debits equal my credits. So we can have some measure of happiness that they are correct. And it's also, again, called a post-closing trial balance because we do it after closing to make sure that we are still in balance, debits equaling credits, after we close all of these temporary accounts and they become big zeros. I hope this has aided in your knowledge of post-closing entries and the post-closing trial balance, and I hope you have a great day.